Assalamualaikum and hello everyone. My name is FARIZAL and I'm your news anchors today. In reporting its earning management, NTK Corporation has engaged in several violations. They have broken several of MFRS, including MFRS 108, Accounting Policy Change in Accounting Estimate and Errors, MFRS 116, which is Property, Plant and Equipment, MFRS 15, Revenue, and others MFRS. So, I will pass to NURUL ADILAH to know some more about NTK Corporation violations.
Thank you, Studio. I am standing outside NTK Corporation's headquarters where inside sources have confirmed major breaches of Malaysian financial reporting standards, specifically regarding MFRS 15 revenue from contract with customers. To give our viewers some context, in December 2025, NTK delivered a massive shipment of high-tech electronic components to Omega Trading Berhad. Crucially, the agreement states that Omega is only required to pay NTK after they successfully sell those goods to end consumers. Despite this clear clause, NTK's director, Ahmad, ordered the accounting team to recognize the full revenue immediately upon physical delivery. From a technical perspective, this is a direct violation of MFRS 15. Under this standard, revenue can only be recognized when control transfers to the customer, because this is a classic consignment arrangement. True control and transaction certainty have not been finalized. By failing to defer this revenue, NTK has artificially inflated its reported income, fundamentally misleading investors and creditors. Our investigate team has uncovered that this manipulation is a textbook case of earning management. Under positive accounting theory, this reflects the bonus plan and debt covenant hypothesis, where management is writing the books just to serve their own economic self-interest. This behavior exploits a massive information gap between management and outsiders. So Director Ahmad especially abused his internal knowledge to hide operational truths from the public. Now, let's look at the assumption and estimation where management operated on the flawed assumption that physical delivery automatically equals a completed sale. In reality, the financial risk and legal control remain completely with NTK until the end consumer purchase actually occurs. Second, regarding the professional judgment, it is true that unbiased professional judgment requires a careful assessment of when performance obligations are genuinely satisfied. So in this case, professional judgment was completely compromised because Ahmad used his position to force early revenue recognition, not based on accounting reality but as a deliberate distortion to boost year-end performance and employee bonuses. To fix this financial distortion, the correct accounting treatment under MFRS 15 requires NTK Corporation to completely reverse the fixed sale. They must debit revenue and credit receivables for the full amount to remove it from the income statement and balance sheet. Then, they must record the deferred revenue by debiting inventory and crediting unearned revenue as a liability until Omega actually resells those goods. Overall, this necessary correction causes their net income and equity to decrease while their liabilities increase, revealing the true unmanipulated state of the company. Omitting this vital correction means the current financial statements are legally non-compliant. Instead of an honest reporting process, management chooses to manipulate the earnings to look much higher than they really are, completely misleads investors and banks about the company's true financial health. Now, the manipulation doesn't stop with revenue. Let's go live to our corporate field reporter, AMMAR, who is tracking a second major issue regarding asset valuations. So, AMMAR, what do we have for us? Income.
The second major financial reporting issue is management's decision to extend the useful lives of several high-value manufacturing assets without conducting a formal technical evaluation. This violates MFRS 116 and MFRS 108. From a theoretical perspective, this is an example of accrual-based earnings management through the manipulation of discretionary accruals. By extending the useful lives of an asset, management reduces depreciation expense and inflates reported profit without affecting cash flows. Under positive accounting theory, this reflects the debt covenant hypothesis, where management uses accounting flexibility to avoid breaching lending requirements and create a misleading impression of financial stability. According to MFRS 116, an asset's useful life must be reviewed annually and revised only when needed. MFRS 108 also requires changes in accounting estimates to be supported by reliable new information or evidence. Since no technical assessment was performed, the revision is not compliant with these standards. Changing an asset's useful life requires professional judgment supported by engineering assessments, usage records, and physical inspections. Without this evidence, the original depreciation schedule should remain, and the unauthorized change must be reversed. If left uncorrected, depreciation expense will be understated, causing the net profit and the non-current asset and also the total equity to be overstated. It also keeps the debt-to-equity ratio artificially below Zenith Bank's 50% covenant limit, misleading the shareholders and the lenders. To correct the misstatement, NTK Corporation should debit depreciation expense and credit accumulated depreciation using the original depreciation schedule. This adjustment will reduce the net profit and asset carrying values, ensuring that the financial statements present a true and fair view.
We look at the next issue. The issue is the newly hired accountant ALIA was instructed to adjust the financial records accordingly. Additionally, NTK issued new convertible debt to fund a new project. The director AMMAR was confident this would not adversely affect earnings per share. Accordingly, the financial statement disclosed only the earnings per share under MFRS 133 with minimal additional information. First of all, from a theoretical standpoint, AMMAR action is a clear example of information asymmetry under agency theory. As a manager, AMMAR knows the true hidden risk of the company, but he chooses to hide them from the owners and investors. By hiding the diluted earnings per share, he is also taking advantage of the bounded rationality of investors. He knows that external investor has limited time and information, so they will likely look at the high basic earnings per share headline figure and miss the hidden risk. The explicit motivation driving this non-disclosure is a capital market motivation. NTK Corporation is under immense pressure to maintain high investor confidence and secure favorable terms to fund its new investment project. Secondly, from a technical accounting perspective, this omission constitutes a direct violation of MFRS 133 regarding earnings per share. Under MFRS 133, a public listed entity that has potential ordinary share in issue is strictly mandated to calculate and present both basic earnings per share and diluted earnings per share with equal prominence on the face of the statement of profit or loss and other comprehensive income. Because convertible debt grant holder the contractual right to convert their bond into ordinary share, it represents a dilutive financial instrument. Thirdly, let's discuss the explanation of assumption, estimate, and professional judgment applied here. Omitting this calculation based on management's optimistic forecast is non-compliant with standard financial reporting practice. AMMAR misused his professional judgment by allowing his subjective belief that the new project would succeed to override the objective requirement of MFRS 133. Lastly, we must look at the impact of the financial statements where relevant. By masking the potential dilution, AMMAR artificially curates a financial image of stable, robust earning performance. If left uncorrected, the financial statement remains fundamentally non-compliant and misleading, presenting an over-optimistic valuation of the company's current share to the capital market. Specifically, this omission materially mistake of statement of profit or loss and other comprehensive income by pricing an artificially inflated or overstated EPS figure. The correct accounting treatment requires NTK Corporation to apply the if convert method at the end of the reporting period. This entails adjusting the numerator by adding back the after-tax interest expense that would be saved if the debt were converted and adjusting the denominator by increasing the weighted average number of ordinary shares outstanding. So, thank you.
Thank you, Fariz, for this insight. We just received another major update in the NTK holding case. Our source revealed that only days before the financial statement were authorized, the company major client Alpha Tebrahyde was declared bankrupt, but the CEO refused to disclose the information in the financial statement. Clearly, this is a major breach of MFRS 110 events after reporting period. According to the standard, an event is classified as an adjusting event when there is evidence of condition that the event existed at the end of the reporting period. Furthermore, the bankruptcy of a customer after year-end usually confirms that the customer was credit impaired at the reporting date, so receivables and impairment allowances should be updated. This further proof that they also have breached MFRS 9, where the entity must recognize the expected credit losses for all instruments that have experienced significant increases in credit risk or when it becomes credit impaired. The company failure to adjust the financial statement accordingly to the appropriate standard under MFRS 110 and MFRS 9 represent a discretionary accrual management, as AMMAR intentionally entrusted the accountant to omit the bankruptcy from the financial statement. This action has resulted NTK in reporting an understated bad debt, causing both profit and trade receivable to be overstated. From this, we can see that their action is highly motivated by the debt covenant motivation, where NTK manipulate the transaction to maintain its debt-equity ratio under 50% in order to avoid breaching the covenant given by Zenith Bank. Violating the covenant would trigger penalties that can harm both reputation and the financial health of the company. The bankruptcy that is reported ahead of the authorization of the financial statement should have been evidence that it existed at the end of the reporting period. In order to ensure that the impairment allowance represents accurate information at the reporting period, the company should revise its estimate of expected credit loss by re-evaluating the risk or probability that loss occurred to reflect this assumption, and alpha tax receivable should have been written off by the management if there is no reasonable explanation in recovering the outstanding balance. As a result, the financial statement would recognize a bigger impairment allowance and simultaneously lower the carrying amount of trade receivable that have been previously overstated by the company. This action would provide more accuracy and transparent picture of the company's financial situation.
I would like to highlight from Ahmad's situation first. For observe, Ahmad could clearly see that NTK was under pressure because of loan confidence, investor expectation, and the needs to show strong EPF. However, instead of treating the pressure as a reason to be more careful and accurate, he used it as a reason to manipulate the financial statement. For thing, Ahmad should have thought that what would happen if Alpha Tax bankruptcy was hidden, if revenue was recognized too early, if asset useful life was changed without proper support, and if EPS disclosure was incomplete. He would have realized that these actions would mislead investors and other users of financial statement. For understand, Ahmad failed to understand that his duty as a director is not only to protect the company image, but also to ensure the financial statements are truthful, fair, and in line with accounting standards. He do not understand that honesty and accountability are more important than short-term appearance. For remember, Ahmad should have remembered that he was trusted to act in the best of interest of the company and stakeholder. She would have remembered that a director must not misuse his power by ordering unethical accounting treatment. For reflex, Ahmad should have looked back and considered the damage his interaction could cause. His action may have helped NTK look better for a while, but they could lead to loss of trust, penalties, and serious harm to a company later. For remorse, Ahmad should feel regret for making unethical decision and should correct the financial statement immediately. Remorse means accepting the mistake and take responsibility for fixing. Now, let's talk about ALIA. For observe, ALIA could see that Ahmad's interaction were not consistent with proper accounting practice or standards. He knew that excluding alpha tax, bankruptcy and follow other adjustment could affect the truthfulness of financial statement. 14. ALIA should have thought carefully about the consequences of obeying the instruction. If she followed them, the account should be misleading, users would be affected, and he could become involved in unethical reporting. For understand, ALIA need to understand that her duty as an accountant is to protect the public interest, including stakeholders, and follow accounting treatment, not simply obey the management. Even though she was on probation, the responsibility did not disappear. For remember, ALIA should remember that accountants are trusted to prepare honest and accurate reports. He should remember her ethics, her standards, and her responsibility to do the right thing even under pressure. For reflex, ALIA should think about the conflicts between obeying Ahmad and protecting the integrity of the accounts. She should realize that stay silent may protect her job temporarily, but it could damage her integrity and future professional work. For remorse, if ALIA already follow the unethical instruction, she should feel regret and take steps to correct the matter. If she should speak up, seek for advice, and help restore the proper financial reporting for the company. For Ahmad's action, his niat was to meet the loan covenants, attract more investors, and maintain a strong company image. His ikhtiar was to interact in proper accounting treatment to achieve those goals. His amanah was broken because he misused the trust given to him as director. His mukarrabah was weak because he did not hold himself accountable for the wider consequences of his actions. His natijah could be serious damage to NTK reputation, legal problems, and even a threat to the company going concern status. In perspective of ALIA, her niat should be to tell the truth and produce proper financial statements. Her ikhtiar should be to question the instruction, seek advice, and escalate the issue if needed. Her amanah is to protect the trust placed in accountants by stakeholders and the public. Her mukarrabah means he must remain self-aware and responsible even the management pressure is strong. Her natijah should be accurate, transparent, and standard compliant with financial reporting. In conclusion, Ahmad failed because he chose manipulation over integrity, while ALIA faced a painful ethical choice between obedience and professional duty. This case shows that the financial reporting is not only about numbers, but also about honesty, responsibility, and encourage to do what is right.
Thank you to the financial analyst for the insightful analysis. As we just heard, this case wasn't simply the result of accounting mistake. It was also a failure of ethical leadership and professional judgment. So, what can companies do to make sure history doesn't repeat itself? Our first recommendation is for companies to establish and strictly enforce comprehensive codes of ethics. Every director and member of management should clearly understand their ethical responsibilities when preparing financial report. To make this more effective, companies should conduct regular ethics training so that these principles become part of everyday decision making, not just words in a handbook. At the same time, a clear disciplinary policy should be in place to hold anyone accountable if the code is breached. Why is this so important? Because a strong code of ethics creates a culture where integrity comes first. It provides the director with clear guidance, reduces the risk of unethical behavior, and encourages them to make a decision that complies with accounting standards. Most importantly, it sends a powerful message to shareholders and investors that the company values honesty, transparency, and accountability, qualities that are essential for building a long-term trust. Our second recommendation is for companies to seek independent external consultation before making significant financial decisions. Instead of relying solely on their own judgment, directors like Ahmad should consult qualified professionals such as external auditors or accounting experts, especially when dealing with complex accounting matters. Companies should also require documented evidence that professional advice has been obtained before approving major financial reporting decisions. In addition, regular internal and external audits should be carried out to ensure ongoing compliance with accounting standards. This approach offers an important safeguard. Independent experts provide projective opinions that reduce the risk of bias or self-interested decision. The guidance helps the director apply accounting standards correctly, improve the quality of financial reporting, and strengthen transparency throughout the organization. In the long run, companies that prioritize ethical decision-making and professional advice are far more likely to earn confidence of investors, protect their reputation, and achieve sustainable success.
To solve the ethical issue of ALIA, our first recommendation is to establish an independent whistleblowing channel and ethical escalation pathway. Instead of approving the fraudulent entries, ALIA should have prepared a technical memo citing MFRS 15, MFRS 116, and MFRS 133 to support her refusal. If the pressure continued, she should have escalated the matter directly to the audit committee. Not just that, Entity Corporation should also implement a secure and anonymous whistleblowing system that reports to independent non-executive directors. This strengthens governance, protects employees from retaliation, and promotes professional integrity and compliance. Our second recommendation is to implement a two-key system or dual sign-off for major accounting decisions. ALIA should also have sought guidance from the Malaysian Institute of Accountants or a trusted professional mentor before making any unethical decision. NTK Corporation should require a dual sign-off for significant accounting adjustments, such as revenue recognition and changes to asset useful lives. If there is any disagreement, the transaction should be suspended until it is reviewed by an independent auditor. Based on our recommendation for ALIA, the Safe Reporting Hotline and Escalation Path helps prevent future misconduct by giving employees a secure way to report unethical behavior without fear of retaliation. It also strengthens compliance by allowing concerns to be escalated directly to the Independent Audit Committee, ensuring that the MFRS requirements are upheld even when management applies pressure. From an Islamic ethical perspective, it promotes muraqabah by encouraging accountability and ethical behavior. In the long term, it builds a culture of integrity while reducing legal and reputational risks. Our second recommendation for ALIA, the two-key system, prevents misconduct by ensuring that major accounting decisions cannot be approved by a single individual. Any disputed transaction is suspended until it is independently reviewed. This will strengthen the internal controls and supporting continuous compliance with MFRS. From an Islamic perspective, it reinforces amanah by making integrity part of the accounting process. Over time, this improves the reliability of financial statements, increases the stakeholders' confidence towards our company, and supports the company's long-term sustainability. Thank you.